Welcome and thank you for joining me for Tax Break. This is a podcast about South African tax for South African tax professionals and practitioners. My name is Pieter van der Schwan, and in each episode I discuss an aspect or a recent development in South African tax. And I try to keep the episode short enough that you can listen to it while you're driving or when you need to take your coffee first thing in the morning. This episode and the next one, I'll be talking about the conduit principle that applies when we're looking at the taxation of trusts, or as some people also refer to it, the flow-through principle. Now, in today's episode, I'll be talking about an amendment to Section 25 Capital B of the Income Tax Act, that it was already made a year or so ago, and it is in effect. But I think we are getting to a point where trustees would need to take decisions and draw up resolutions for those decisions for the 2025 year of assessment. And I think it's a good time to maybe just remind you of this change. So let's start at the beginning. What exactly is the conduit principle? Now, it's something that was established in the Armstrong case in 1938, and it was subsequently confirmed by the appeal court in the Rosen case. After that, it was then legislated into Section 25B in the early 1990s when the Income Tax Act changed for a trust to be viewed as a separate person. So to give you an example of how this conduit principle would work, let's look at the case of a discretionary trust that owns property and investment property, and it earns rental income from it, and the trustees take the decision to vest this rental income in a beneficiary. So the effect of the conduit principle would be that the beneficiary is taxed on the rental income if it vests in the same year in which it accrued to the trust. And secondly, that the rental income would retain its nature as rental income for that beneficiary. Now, I think before we get to the amendment, I would like to look at the technical wording of Section 25B. So it's something that I try not to do in these episodes, but I think in the context of Section 25B and these resolutions and things that we are speaking about, there are quite a few things that would be useful reminders as we go through the detail of the provision. Right, so the provision 25B1 starts off by saying that it applies to any amount, and then it qualifies that to say that it doesn't apply to amounts that are of a capital nature which is not included in gross income, or amounts that are contemplated in paragraph 3B of the second schedule. So in other words, if the amount is of a capital nature, 25B doesn't apply, or some lump sums from retirement funds. So those amounts of a capital nature, we'll talk about them in the next episode when we look at how this conduit principle applies to capital gains. Right, so for the amounts that are within the scope of Section 25B, if they are received by or accrued to or in favor of a person during a year of assessment in his or her capacity as a trustee of a trust, so we're looking at amounts that are really received by or accrued to the trustees. Then, before we get to the actual deeming provision of Section 25B, it also clearly states that the principles of 25B are subject to the provisions of Section 7. Now, Section 7 contains the attribution rules. And then we get to the actual deeming provision that says, to the extent to which this amount that we are looking at has been derived for the immediate or future benefit of any ascertained beneficiary, and this beneficiary has a vested right to that amount during the year, so during the year of assessment in which it accrued to the trustees or was received by the trustees, this amount will be deemed to be an amount that has accrued to the beneficiary. And to the extent to which the amount is not so derived, so in other words, it's not for a specific beneficiary's benefit and the person doesn't have a vested right to it, it shall be deemed to be an amount which has accrued to the trust. Right, so that is the deeming provision. A few things I would like to maybe just highlight. The first is that Section 25B really reflects a deviation from the normal legal principles that we find in the tax legislation. So if we look at it from a legal perspective, a trust is not a separate legal person, but because it's defined as a person for tax purposes, it is considered to be a separate taxpayer. So therefore, we've got this deviation to say that where a trustee receives an amount, and that amount, the trustee only acts in the capacity as a trustee basically for the benefit of the beneficiaries, but where the trustee receives that amount, although it's not for his or her own benefit, the amount is accrues to the trust, which is then deemed a separate person for tax purposes. So that's already a deviation from the normal, let's call it, legal position. Then, where the deeming rule starts to apply is when this amount is applied for the immediate or future benefit and a benefit of a beneficiary, and this beneficiary has a vested right during that year. Now, important, the person must, for the flow-through principle or the conduit principle to apply, the beneficiary must already have this vested right during the year of assessment in which it accrued, the income or the amount accrued to the trust. So what does this mean? I believe it's a legal question to say, but when does vesting take place? In addition to being a legal question, I think it's also something that if you look at the governance documents of the trust, which in most cases would be the trust deed, that trust deed would tell you what the process is that the trustees need to follow to make distributions and to take resolutions to vest amounts in the beneficiaries. But this is quite an important aspect, seeing that if vesting didn't take place, the conduit principle wouldn't apply to that amount. And then I think, as you would have already gathered, the effect of the conduit principle is that the beneficiary is taxed on the amount, not the trust. Then in many cases, it could be that the beneficiary's tax rate is significantly lower than the trust's 45%. Right, then the key part of this episode is then the amendment to Section 25B. Now, this amendment took effect for years of assessment starting from 1 March 2024. So it's already in effect for the 2025 year of assessment. And what the amendment really says is that this conduit principle that I just explained would only apply to amounts vested in resident beneficiaries. So put differently, if the beneficiary is a non-resident, then the conduit principle doesn't apply and the trust would pay the tax. So let me illustrate it with an example again. Let's say we've got a trust with 200,000 of income. We've got two beneficiaries, one is a resident, one is a non-resident, and the trustees wish to vest 100,000 Rand in each one of them. Now, when the trustees do the vesting, they need to make the vesting happens in accordance with the trust deed. And what I think you'll find is that many trust deeds would only allow the trustees to vest what is actually available. Now, this is where I think practically one needs to consider the effect of the amendment. So the 100,000 Rand, if the idea is to split the income and the effect of the income between the two beneficiaries, the 100,000 Rand would flow through to the resident beneficiary, and that person would be taxed on it in his own name. So that person must declare the income. Of course, through the IT3T and those kind of things, the trust would need to inform SARS of the vesting that occurred. And then for the 100,000 Rand that is basically designated for the non-resident, the first thing is that 100,000 Rand from a tax perspective would not be deemed to have accrued to the resident or to the beneficiary. It would be deemed to have accrued to the trust. So in other words, the trust needs to pay its 45% tax on it, and then there's 55,000 Rand left. So I believe that the right way of wording this resolution then would be to say that you will vest 55,000 Rand. That is what the trust, that's the assets that the trust would have after setting its liabilities that would be available to vest in a beneficiary. Now, I guess if the trustees are not aware of this amendment, you could end up in a position where they basically say we'll vest half of each amount in the, or half of what remains in the trust will go to each of the beneficiaries, and then you start to get to this circular reasoning where the portion that goes to the non-resident must first be taxed in the trust to determine how much remains to be split on a 50-50 basis. And if you split it on a 50-50 basis, technically the resident beneficiary would start also bearing the tax cost of the distribution to the non-resident beneficiary. I wrote an article about this amendment with Pete Nell, and we raised a few questions or issues that you need to also look out for. One of them is that the foreign jurisdiction where the beneficiary is situated may also want to tax the amount that vests in the beneficiary. And if the beneficiary didn't pay the tax himself, it could be that jurisdiction doesn't necessarily give a tax credit for the taxes already paid by the trust. So that's one thing to consider depending on the jurisdiction. I think also in the context of vested trusts where the trustees don't have the flexibility to basically balance the distributions back to make sure each beneficiary bears his own tax cost, I think this amendment could cause a few problems. And then we also raised a few questions about how exactly withholding taxes would work in the case of something like, for example, dividends. Right, so in closing, I think the key points to take home from today is that the conduit principle would no longer, with effect from 1 March 2024, apply to distributions that you make of income to non-resident beneficiaries. And from this, there are a few practical considerations that you need to look at. For example, how to word your resolutions, having to go back to the trust deeds to understand what can or can't be distributed. And then, as I've also mentioned towards the end, these issues about other jurisdictions wanting to tax the income and not necessarily giving a credit for the tax suffered by the trust. Right, that's it for today. If you like the podcast, please subscribe on your favorite podcast platform and tell all your friends and colleagues about it. If you've got any feedback, whether good or bad, or any suggestions for future topics, please send me an email. My email address is in the show notes. And just a reminder, as always, nothing I said today is intended to be tax advice or even a substitute for tax advice. Until next time, goodbye.